In New York City on this Friday, November 15th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, U.S. stock futures falling this morning. Traders paring back rate cut expectations after comments from Fed Chair Jerome Powell and amid stronger than expected retail sales data. The central bank chief saying that the U.S. economy is in remarkably good shape and leaves more room to ease interest rates carefully. The Boston Fed President Collins adding to the commentary, saying a December cut isn't a done deal.
Plus, hedge funds pulling back on big tech. 13F filing showing that fund managers cut their stakes in Amazon and Apple in the third quarter. This coming amid the market's rotation out of tech. Meanwhile, filings from Warren Buffett's Berkshire Hathaway showing that the famed investor bought into Domino's Pizza and Pool Corp. Rounding out the filings, billionaire David Tepper trimming his Alibaba stake after his call to buy everything China in September. However, the stock is jumping today after the company beat profit expectations in its earnings.
And we're watching Tesla and Rivian shares as well. Reports showing that President-elect Trump wants to do away with the electric vehicle tax credit. The incoming president also confirming JP Morgan CEO Jamie Dimon will not be included in his administration.
October retail sales coming in slightly stronger than expected, up 0.4%. Estimates were calling for an increase of 0.3%. Also seeing a big upward revision to the September data, now an increase of 0.8%. That was up from the prior reading of an increase of 0.4%. We want to bring in Jerome Martise, LSEG's Director of Consumer Research. And Jerome, when you take a look at these numbers, obviously pointing to the fact that the economy is maybe stronger than many forecasters had anticipated up until this point. What's your big takeaway from today's print?
So when you dig into the data, it is very key that the one number that stood out was the year-over-year growth on e-commerce sales. That grew a robust 7%. And this is telling because last year, October, we also saw a very strong October Amazon Prime Week. And it doesn't just benefit Amazon. There's a lot of other retailers that piggyback on the event. So the fact that it grew 7% on top of a very strong Prime Week last year, it's telling us that the consumer is still gravitating towards those online deals. They're still being very price conscious and are only opening up their wallet for those discretionary items unless they feel that they're getting a discount, a value for their money.
Which retailers do you believe are making the best transition and transformation to a digital first mindset, or at least a digital leading transformation for their growth story?
Absolutely. The one retailer that is giving Amazon a big competition is Walmart. In fact, according to our StarMine data, Walmart is likely to beat earnings estimates and post a positive surprise next week when they report. And this is mainly because of that, exactly what you talked about. They're giving the consumer the ability to shop the way they want to, whether it be like ordering it on your mobile on your way and picking it up at the store on your way home, or just, having it delivered right there from the store to your house. Walmart is definitely giving Amazon a lot of competition. Not only that, but what's key is that Walmart gained so many shoppers during the pandemic. And then on top of that, then again, even more shoppers over the past 2 years that were looking to trade down. A lot of upper middle class consumers, high-end consumers. And as a result, that now translates into loyalty. Consumers that are coming to Walmart as a one-stop shop. And therefore, they're likely to do very well over the next 2 quarters, this quarter and next quarter.
So how does it set us up then going into the very important holiday season? Those strong growth trends, is that something that you expect to continue?
Yes, but also what's key on consumers' mind right now is that value proposition. Right? And that's why Walmart has become the one-stop shop. Other retailers that are also expected to do well are, for example, the Gap. This is because of its Old Navy division, which has kind of had a comeback, especially during the back-to-school season, and is one of the favorites going into the holiday season. Off-price retailers like TJX and Ross, because those consumers still want designer clothing for less. Those are the names that are going to be doing well for the holiday season.
How much more of a drag do you think there is on some of the home furnishings stores, as we've kind of seen that be a through line between the CPI report and now between the retail sales data as well?
So it's interesting because we're kind of making that transition, whereas we might see a pickup on that in 2025. Reason being is already today we saw some signs in the retail sales numbers. When you look at the month-over-month data, the strongest segment there was electronic and appliances. This was a sector that was the strongest, remember, during the pandemic. So which means that that strength could signify that we're seeing that consumers are finally renewing some of those products, right? So we might be starting to enter in that cycle where we will see some renewals of those products, especially in the home furnishing, but in 2025.
What about the risk of tariffs? Is that essentially, or could this essentially halt some of this momentum?
Potentially, yes. It's interesting that you mentioned that because about 20% of the retailers that already reported have mentioned tariffs in their earnings call, especially Home Depot this week. And it's important to know that retailers do have options, especially a retailer like Walmart, who is very powerful. They can either choose to not hurt their gross margins and just change the supplier. They can absorb the cost. Or one thing to keep in mind is that a lot of retailers have now diversified their suppliers list, especially after everything that happened during the pandemic. And that's what I think that was the message of Home Depot. This will be impacted industry-wide, but it's not our first time to the rodeo.
What would you say the vibe is overall? We only have about 15 seconds here. The vibe of the consumer going into the holiday season right now. We've heard words like resilient. We've heard battle tested before. What would you kind of summarize the consumer as ahead of the key shopping season?
That's interesting you mentioned that word because I think it's more of a battle between the retailer and the consumer. The consumer is value oriented and is looking for all those deals, but the retailer is still being very stubborn. In a collaboration with Centric Market Intelligence, we discovered that retailers are not giving consumers the discounts that they want. Remember, what is the magic number? 40%, unless you're getting that 40%. And they have been very stingy. They've been giving the consumer 33%, even during Amazon Prime Week. So.
All right, I know who to look. I don't know. Do I go up to the cashier and say, "Hey, I just want that 40%"?
You can negotiate,
Okay.
yes,
do that.
especially if it's the last item on the shelf.
Look, coming from the household I grew up in, negotiation was a top skill and tactic that was taught. Jerome Martis, who is the LSEG Director of Consumer Research, joining us here on set. Thanks so much for taking the time.
Thank you for having me.
Absolutely. U.S. stock futures falling this morning as yields rise, with traders reassessing the Fed's rate cut pathway after comments from Fed Chair Jerome Powell saying that the central bank can ease more carefully amid a strong economy. Joining us now, we've got Michael Gousset, who is the Principal Asset Management Chief Investment Officer for Global Fixed Income here. A lot to really break down and discuss here. So let's just start with the comments from the Fed. What does that signal to you will really be kind of the pathway going into 2025?
Yeah, good morning, and thank you for having me today. Certainly, the Fed's comments, the Fed chairman's comments, were suggestive of what we've seen in the data, which is that the economy remains on solid footing, that inflation has been a bit bouncy and hasn't improved as much as was expected just 3 or 4 months ago. And as we go through an environment where there's a lot of uncertainty about how policy is going to shift under a new administration, the Fed is taking a wait-and-see approach, becoming even more data dependent than they already were.
Michael, is that a risk to the equity rally that we've seen?
And not as an equity person, but you'd have to imagine that more accommodation in the system is good for equity prices. It's good for risk assets more broadly. So the short answer would be yes, it is a risk to the equity rally.
So then let's talk a little bit more about the bond market and drill down there. Obviously, we certainly have seen reaction there. What does that then tell us about maybe the range bound that we could see for the 10-year?
Yeah, so we've certainly seen the correlation between what's priced in for the Fed over the coming 12 months and the direction of longer-term interest rates. It's pretty much gone one for one as we introduced a significant amount of cuts that were moved in July through September into the market. You saw that 10-year bond yields rallied substantially. And since we've seen some stickier inflation data, some stronger economic news, and now with the incoming Trump administration and thoughts around tariffs and potential for further tax cuts, you've seen long-term interest rates rise. So, as we go into next year, I think there's two things to think about. One is, how sticky is inflation? How stable or healthy is the labor market? And then finally, yields are pretty attractive now. So from an investor perspective, whether that's somebody who's been sitting in money market funds for the last couple of years and enjoying high yields, or even institutional quality investors in pension plans or corporations, you're getting a nice all-in yield today that you haven't seen for most of the last decade.
Is there anything that would suggest to you that inflation does risk spiking once again, or that there would be some type of larger deterioration within the employment situation?
Yeah, both of them are important to think through. So tariffs are expected to be somewhat inflationary. There's some questions about whether that is a one-time hit to inflation or it's something that is prolonged and impacting prices for the next couple of years. And so we kind of come out that inflation, although we think is moving towards the Fed's target rate, is going to take some time to get there. The labor market has shown some signs of deterioration, particularly in lower income segments of the economy. And so it's really important to watch that metric, given the importance of the consumer for the U.S. economy. Regardless of where prices go, if people are not employed, they're not going to be spending, and ultimately that impacts where the Fed could go in the future as well.
Michael, what do you think the trajectory looks like here for inflation? Is there a risk that we could see maybe some upside pressure? And I guess what is that then going to do, or how should investors be thinking about that?
Yeah, there's some statistical anomalies that occur in the fourth quarter that should push inflation in the near term a little bit higher than what we've seen on a month-over-month basis. Some of the big issues have been around shelter inflation, which we do expect to moderate as we go into next year. And so, yes, I think that inflation print will be bouncy. It will cause some consternation in the bond market and potentially the equity market for that matter. But that over time, we are on this slow, steady improving path for inflation. It may be not to the exact level of 2%, but we're going to move in that direction over the course of the next 12 to 18 months.
Which seems more attractive to you? Is it the bond market or is it equities right now?
So I think from an all-in yield perspective, being able to get close to 4.5 on a U.S. Treasury, pushing 5.5 now on an investment-grade corporate bond, and in the 7% range, or even a little higher now for high-yield bonds, that from a risk-reward perspective seems like a pretty attractive environment. Traditionally, when the Fed does start cutting rates, duration becomes your friend. You do get a tailwind as investors do start to chase the prospects for slower growth, which is traditionally why the Fed is cutting policy rates. So our view is that bond markets are attractive here, that it's a good entry point today, and that as we go into 25, you may see that the Fed may add a little bit of juice to that expected return.
All right, Michael Gousset, thanks so much for taking the time to join us.
Thank you.
Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street as stock futures are trading to the downside here this morning. Plus, we're breaking down the slew of 13F filings showing that funds have pulled back on big tech. Shares at Palantir are getting a boost as the firm plans to transfer its listing from the New York Stock Exchange to the Nasdaq. We'll discuss that and much more coming up on Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page here. First up, let's take a look at Domino's and Pool Corp after Warren Buffett's Berkshire Hathaway disclosed stakes in the companies. Berkshire buying 1.3 million shares in the pizza chain in the third quarter, taking a 3.6% stake valued at around $550 million. Berkshire also buying a 1% stake in the pool equipment company that's valued at about $152 million. There you're taking a look at shares of both entities here. I'm just going to zero in on Domino's because that's the tastier part of this trade as of right now. I think that Warren Buffett has had a history of making big bets on some of the household staples, and Domino's perhaps has best positioned itself, especially within the technological advancements that it's infused into that customer experience process. And I think this is getting a nod of approval from Buffy the stock market slayer here, and no doubt a lot of investors out there should take note, especially with some of the advancements that Domino's has been able to do in order to make sure that they can position their company to be looked at as one of the most technologically savvy plays in the kind of quick service or just pizza delivery market here.
Yeah, I mean, I'm still focusing on the fact that you said Buffy the stock market slayer. But let's talk. To me, the big takeaway from these two bets is that it's a bet on the consumer, right? When we had retail sales out this morning, we've taken a look at the recent econ data, once again showing the fact that, yes, consumers are under a significant amount of pressure. I don't think that's any surprise when you take a look at the most recent data, when you even take a look at the poll numbers and the voters and what they were saying was the biggest issue to them this past election season. But again, just looking at the fact that Buffett is betting on the consumer at this time, I think really just shows that he does have confidence in terms of the spending trajectory and what we are going to see, what people are willing to spend in. Take a look at Pool Corp, you take a look at Domino's Pizza. Very, very different budgets, very, very different reasons for buying supplies from both of those companies. But again, I think it just shows the fact that he is confident that the consumer will be willing to spend here and sees the right time to get in and buy both of these companies.
I mean, look, he's got sneakers underneath the Berkshire Hathaway portfolio with Brooks. He's already got some of the other kind of snack categories as well. Why not add pizza?
Yeah, true. Why not? Yep, just keep it in the family, I guess. All things food. All right, let's talk big tech because Amazon and Apple are getting cut as hedge funds reduced their exposure to those stocks. Hedge fund holdings of Amazon falling by $11 billion to $34 billion in the third quarter. That's according to Bloomberg analysis of the data from the 13F filings. Almost twice as many investors reducing their stakes in Apple then added them, putting that in perspective. Both of those tech giants under a bit of pressure here this morning. We talked a lot about how Buffett's positioning within Apple. He cut his position in Apple by about 25% to $70 billion. But again, when you take a look at what we have been seeing, not necessarily a huge surprise when you talk about the rotation that we've been seeing play out in the market, or expected rotation as you look ahead to 2025, the rate cutting cycle, what exactly that could do to other areas of the market. But again, we're taking a look at some of these hedge funds reducing their exposure. And remember, this comes up after a tremendous run, right? So a lot of these companies have made a heck of a lot of money on these bets. So they're trimming their positions. I wouldn't read too much into this, maybe what this tells us about the performance going forward. But again, it is enough to pressure the stocks here this morning.
Profit taking. Look, let's just sum it up as that. Like some of these companies, as we're taking a look at the Apple and the Amazon charts here, and for any of our viewers, investors in either of these companies that have watched the climb, it's the climb, you've been watching that over the course of this year, and more largely a question mark of, okay, if you do take a little bit off the table or trim a position, where else can you find opportunities to either sit on cash right now and then invest it later on, or say add on to the diversification of your portfolio? And I think that's exactly what some of the biggest institutions are looking at right now. I was taking a look at some of the 487 hedge fund SEC filings, 13F filings that were submitted to the SEC. And of those that were aggregated and some of the data had revealed about 239 million, just a little over 239 million were shares that were sold here of these firms, and of course in filings that were dated as recent as September 30th. So all these things considered, there's selling, but again, it's coming back to where can they take some of the chips off the table just to be able to have some dry powder, as we've been discussing, especially as it relates to Buffy the stock market slayer.
That's my takeaway from the show so far.
Let's stick with the 13F regulatory filings as well. Big short investor Michael Burry boosting his bet on China stocks in the third quarter, adding to his positions Alibaba, JD.com, and Baidu, but also adding new bearish options that would provide downside protection. Billionaire money manager David Tepper cut his stake in Alibaba, but increased his overall China holdings to 38% of his reported equity portfolio, up from 26% in June. So these are some of the largest and more outsized moves here. One of the other things to highlight is, of course, that we had seen within the region so much of an effort to insert more stimulus. And sure, that was a boom for the broader China touching equities or China mainland or, just specific to the region. Some of the biggest names within e-commerce were beneficiaries, but now it's right to see some of the reshuffling that we are, as much of that has already played out in the equities price action at this point.
Yeah, I think my big takeaway is there's clearly some hedging going on just regarding the uncertainty right now within some of these China bets. You have Michael Burry, who's adding to his exposure here of Alibaba, Baidu, and JD.com, but at the same time, he's also added to new bearish bet options that would provide some downside protection. So I think that's important to point out. And then when it comes to Tepper, clearly a bit of a pivot there from the call when he said to buy everything related to Chinese stocks just about 2 months ago. When you take a look at some of his recent moves here, trimming his exposure to Alibaba and the iShares China Large Cap ETF here in the third quarter, at the same time increasing his holdings or stakes in PDD and JD.com. So again, they are still seeing some investment opportunity, but clearly not that buy everything landscape, being a bit more selective, which makes sense just given the recent mixed data that we've been getting out of China. The stimulus measures, yes, helping to some degree, but I think a big debate just in terms of how much of a momentum it's really going to add here in the long term.
Yeah, I mean, there was a 35% move higher that we had seen over late September, early October. So it's not like there hadn't been the move. They called for this actually in September, and what we had heard from Michael Burry as well, and kind of the buy everything, or David Tepper had said that, I believe. And so all those things considered, I mean, the move that they anticipated played out. So now it's just, okay, how do we make sure that we lock in some of the profits?
All right, let's also get to some breaking news that we have out. General Motors laying off 1,000 employees as it looks to cut additional costs. The company saying in a statement that it needs to optimize for speed and excellence. We're looking at a bit of a reaction here in the stock this morning, off just about 0.3%. The significance of this is the third time that GM is shrinking its workforce this year. Back in August, they trimmed their software engineer headcount by just about 1,000. Before that, they repositioned and reworked their China workforce. That, of course, included layoffs there amid the ongoing losses that the company is suffering within that market. So a number of strategic moves here from GM, not necessarily anything new. We heard from GM CEO Mary Barra on Yahoo Finance a few months ago talking about the priorities here of GM and how exactly she sees GM becoming a dominant player, remaining a dominant player within the auto space, talking about the fact that they do need to cut costs, they do need to remain nimble. So again, I think this move here that was announced this morning certainly falls into that category. Again, 1,000 employees will be affected by this. GM, though, employing 76,000 salaried workers globally as of the end of 2023. So again, just a fraction of its workforce.
Yeah, absolutely. You got to wonder what portion of this might be some of the end of the year kind of processes that many companies go through. But at the same time, let's think out to how companies are trying to front run the incoming administration, some of even the tax changes or the credit changes for EVs, where GM, Ford, Stellantis, they have already started to reduce some of their own ambitious targets that they had put out into the market 2 years ago. And so any type of pullback there might also mean a direct correlation to reduction in the headcount as well, necessary for some of those efforts also.
All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back with the opening bell. Here's the opening bell on Wall Street as we kick off the final trading day of the week. We certainly have seen a bit of a reversal here following the massive momentum to the upside following the election of President-elect Trump. Now we are seeing a bit of a give back of those gains. And here we stand at the open. It looks like we're going to continue declining into the red, building on yesterday's movement to the downside. You got the Dow opening off just about 180 points. You've got the S&P also moving to the downside here this morning, right around that 5,900 level again as it starts to calibrate here. Of course, that is a critical level to watch here going forward. The Nasdaq Composite also under a bit of pressure here this morning. Yesterday had fallen just about, looks like actually this morning it's just starting to trade here off just about 1%. Let's take a look at the bond market. Some reaction there that we are seeing to the retail sales data that was out this morning. A bit of a move higher here in the 10-year yield. You're looking at a move to the upside of just about 5 basis points here. And as you take a look at Bitcoin, that Trump trade that we have been talking about certainly has been swept up in the excitement. We've seen a bit of a give back here. You're looking at further losses here today, off just about 2%, but still up right around 89,000. Let's flip over to the sector action, starting off with what we are seeing here this morning. And we're looking at financials, utilities among the leaders in today's trading action. On the flip side, we've got technology under pressure once again. You talk about the Nasdaq adding to its recent losses here over the last several trading days. You also got consumer discretionary off just about 0.6%. And taking a look at the 5-day action, giving us a better idea of what we have seen here. Energy financials are still the outperformers. Materials off just about 2.6%. Healthcare, the big loser so far this week, off about 4%. Let's kick it over to Jared Blickery as a closer look at this movement that we're seeing. Jared.
Well, thank you, Shauna. I was just told I have unlimited time here, so buckle your seatbelts. I'm going to go back to the Nasdaq, then we'll get into some small cap action. This is a 5-day price action, and in fact, we have been down each of the 5 days this week, but I want to show what's happened over the last 10 days because we're about 9 days into this post-election rally, and I'm going to put a line chart so you can see exactly where we are. We're still in the upper half of the range here, but I want to go to the small caps, which came into basically the 50% retracement level, and that's an important level that traders watch between the closing high on Tuesday and the closing high up here at the most recent highs. Now we came down here, and if we bounce, that would be probably a bullish signal, and we'll have to see what comes of that. But a lot of the markets are just consolidating some of these recent gains. Some of them are giving back more than others. I want to take a look at the transports because those are remaining very strong, and we can see this is this particular security is trading in the upper end of its 10-day range right here. We can also take a look at the dollar because the dollar just hit a really big level. This is a 10-day chart as well. You can see it's basically been going up the entire time. And if I put a 3-year chart, I'm going to show you these levels that we're just now coming off of. So we were in the midst of a 5-day rally. We came up to this important trend line, resistance level, which is held going all the way back to early 2023. And now we are just so ever much declining off of that. So that's an important thing that I'm going to keep tracking here because if the dollar does head higher, that could be an impediment for not only futures, but also equities. Now, I also want to take a quick look at the 10-year T-note yield. That has been heading higher. That's a long-term chart, 3 years as well. I want to take a look at the 3-month, and we can see 4.47. Looks like it wants to touch 4.45. Might have done so already, but the trend is definitely up in yields like it was with the dollar. So my question is our yields going to roll over with the dollar potentially? And we'll have to see if that comes to fruition. Let's take a look at some of the happenings in sector land. We're just going over the sector action for the week. Healthcare really taking on the chin. Just want to go to a long-term chart. Here's a 5-year chart. Let's dial this down to a 1-year. We're just now breaking some big support levels. We had come down to prior resistance here, and now we are breaking through. So kind of some negative developments for the healthcare sector, but energy, financials, communication services, all in the green here. I'm going to get to some futures action, and then we'll see if we have some time for some stocks. This is the 5-day price action in futures. This wasn't even on my radar, but cocoa was up 18%. Let's take a quick look at the 1-year chart. I'll put a line chart on here, and we can see, well, it has come right now basically almost to a trend line that a lot of traders might be watching, so it's consolidating, and we'll have to see. Until it breaks out of this channel, either to the upside or the downside doesn't really mean that much. But what I wanted to show was gold and silver, and we'll see if I can find GC equals F. I see silver right here, so we'll just stick with that. We did see since the election a pretty big decline in both gold and silver. Copper also selling off, so the metals complex not liking that. But you remember the opposite reaction in the dollar. So the dollar has been rising, and predictably commodities have been falling. That's what tends to happen. And so that Rubicon level in the dollar that I was watching, 107 or thereabouts in the Dixie, that's something to watch, especially to the upside if we do breach that. Let's take a look also at the Nasdaq 100, where we can see what's happening. This is all of this week, by the way, and you can see a lot of red here. I did say that the Nasdaq 100 has been down every day this week. Let's take a look at what's happening today, and we see more of the same. Nvidia down 2%, Amazon also down 2%. Looks like Tesla, though, kind of bucking the downward mega cap trend. Let's take a quick look at what's happened with Tesla over the last 10 days. Speaking of maintaining gains, Tesla is holding on to more than half of its post-election gains, which I would consider bullish. So the short-term trend in Tesla is still intact until proven otherwise. Brad.
All right, a detailed look at today's early trade plus the year-to-date context. Yahoo Finance's own Jared Billick. Jared, appreciate it. Time now for today's strategy session here as the U.S. stock rally is showing signs of tiring out, with markets looking to close out the week in the red. Joining us now, we've got Omar Aguilar, who is the Schwab Asset Management CEO and CIO. Great to have you here with us this morning. So, Omar, first, as you think about where the markets have moved post-election, perhaps on relief that we didn't see major legal challenges and we had largely an answer the next morning before markets even opened. Now what? Because I think many investors out there may be looking for what the next catalyst could be, especially as the Fed is continuing to signal what their pathway may look like.
Yes, no, good morning. It's certainly, a very rational reaction and very normal reaction that we've seen in the market. So markets and investors don't like uncertainty. And I think, the fact that we did have a very clean and clear results of an election, created a rally. And that has been historically the case when you do have, clear results of an election. Usually that tends to just be very positive, for the markets. Now we're in this process where after that, having that rally, after people started to just look at, what the implications will be of the new administration, clearly there are certain trends that happen because of campaign, discussions and campaign, rhetorics that all of a sudden started to just discussing about the potential for tariffs, the potential for immigration reform, the potential for tax reductions. And those things are starting to just go into the market in sort of like a post-reaction of election, where we saw in this rally since the election results, that was pretty much a very natural, components of what people tend to do, trying to stay ahead of what may come ahead. What we're seeing this week, though, is that now, the other part of the brain, this is more behavioral finance, it comes into play to say, well, there is still now more uncertainty of what this may mean. There is obviously a big trade-off between economic growth and potential tariffs and potential inflation, and those things are coming together. And when you put, those parts of uncertainty related to policy together with what we see for central banks and the implications on Federal Reserve, from what we heard from the Jerome Powell yesterday, that creates obviously additional volatility and therefore, the opportunity for investors to take something off the table and take some profits this week.
Omar, how should investors, though, be looking at the massive climb? Yes, it does make sense that some investors are starting to take profit here, but this run-up that we've seen, do you think it has merit?
Well, a significant portion of that, it has to be, and just so that we're clear, the drivers of a lot of equity will have to do with economic growth, number one. So, the fact that you have the possibility of having, lower taxes, a little bit of a fiscal stimulus, and potentially the ability for having that in combination with lower rates, that obviously puts a significant amount of opportunity for, the market to continue to grow. Again, economic growth is a big driver of this. And in that perspective, the potential for economic growth until the new administration is there. There is information what we saw 8 years ago, and therefore that seems to be there. The other piece has to do with earnings. Earnings earnings, obviously, and fundamentals of corporations tend to do well. That is what is not very clear yet. I think earnings, and specifically because of valuation, tends to just be a little bit ahead of themselves. And the question will be, how would all these potential implications on policy will affect corporations and how they will, adjust. And I think the biggest question mark, which is the reason why we still need to see some data going into the first quarter of next year, is how the situation related to inflation will play. And I would probably say not just investors, but in general, even the Federal Reserve will still going to have to see how the inflation picture may play to just realize whether or not, the levels of the market here are justified or not.
Omar, where does that leave big tech when you talk about some of the policies of the new incoming Trump administration, obviously expected to take maybe a little bit of a lighter approach when it comes to regulation? I spoke with the IBM CEO, Arvind Krishna, at our Invest earlier this week. He was very optimistic maybe about what that spells out here for big tech. How are you looking at that from an investor perspective?
Yeah, well, deregulation is clearly a big part of the discussion around what potential earnings, future might be, and potential growth of earnings, going into the next few years. And I think, the fact that there is discussions about deregulation, the fact that there is discussions about potential avenues for, getting more support and more stimulus into economic growth and earnings potential, that's actually, fairly positive for the market. And we actually see even more the opportunity for innovation as you reduce rates in combination with the fiscal stimulus, has driven, a lot of investors to small caps. As the rally that we saw post-election on small caps reflects that specific ability of obviously understanding, what the implications might be for those aspects. Now, I would probably say that the part that is a little bit, uncertain is that because of the discussion related to tariffs, because of the discussion related to the potential of dollar strength, all those mega cap companies, particularly those multinational companies, when they have significant amount of revenue coming from overseas, may not necessarily, be, as good as the rest of the ones that are mostly domestic. So I would probably say, in the context of what these policies may mean, may actually be reflected more in domestic, gains relative to revenue coming from overseas.
Omar, when you think about investors who may be trying to front run any significant policies that had been campaigned on by the president-elect ahead of the changing of the seats and changing of the guards in the White House, what do you believe will be the most significant that they should perhaps reposition their portfolio around?
Well, we've been talking about it. I think probably the biggest change we made in our analysis going in through the next transition of administrations had to do with two things. We were very clear that the pace on the Federal Reserve for reduced rates was going to be a little faster than what it seems to be going now. We even heard yesterday, the Jerome Powell talking about specifically that there is no need to hurry to cut rates. What that means is that probably the terminal rate on the Federal Reserve, rates may not necessarily be as low as it was, prior to, the elections. And what that means is, a big part of what, discussions with investors and with our clients here at Schwab has been that, well, we just don't want you to rush and change your duration of your portfolio. We were thinking that, people needed to extend the duration given the prospects of lower rates on the short end of the curve. However, we're now at the point where we're saying, like, well, duration, where you have it may be the right place, and there is no rush to extend duration anymore. So that's one of the changes that we are continue to work with our clients on. And the second one is, we think that the transitions from the low part of the end of the business cycle into the early part of the recovery of the economic cycle is actually going to be a little faster. Again, based on what we discussed earlier about potential economic growth, this idea of soft landing seems to be moving well, and therefore the rotation towards cyclicals and small caps seem to be a well-positioned, strategy.
Omar Aguilar, always great to have you. Thanks so much for hopping on with us. Coming up, a crucial deadline for Supermicro Computer as the company faces a potential delisting. What our next guest is saying about whether or not it's a buying opportunity. That's coming up next. Supermicro Computer at risk of being delisted from the Nasdaq. The company has until tomorrow to submit a plan to regain compliance after delaying the filing of its financial statements. Now, this follows Supermicro's auditor Ernst & Young resigning in October, citing an unwillingness to be associated with the company's financial statements. Joining us now, we want to bring in Sylvia Jablonski, Defiance ETF's CEO and Chief Investment Officer. Sylvia, it's great to have you on back on the program. I know last time we spoke, you talked about the fact that maybe it was a buying opportunity here for Supermicro. Obviously, we're in a bit of a different position here today. What should investors, or how are you thinking about this heading into the weekend?
Yeah, good morning and great to be here with you today. Like everyone else, I'm on the edge of my seat. I would like to see if they come in and do their filing on time. I think if they do this, the stock has the potential to surge, at least in the near term, for the sake of just like actually submitting it on time. But the longer term picture here, that's, and that's a huge risk. I mean, what I would say is we kind of have to wait and see, right? If you hold a lot of Supermicro, you might kind of sit on your hands and see what happens here. I wouldn't say that buying is necessary ahead of the filing of the report. They've been in this position before, right? And they seem to have these issues with their reporting. So it's kind of difficult to know what's going on. If you look at the numbers that they represent and present, the stock is up over 200% last year, 87% the year before. Revenues are doubling and tripling, every other year that they report earnings. They have customers like Nvidia. Everything sounds really good. They're in the right place at the right time with the right product and the right ecosystem that they provide to. But it's just all about these reports. Is it negligence or is it fraud? And I think that, that's what the market needs to hear before the stock will resume, going one way or the other.
Sylvia, everything that you just laid out sounds like it's too good to be true. And so that is what is at stake here, is that what they had put out into the market and what had driven some of those larger legs higher may not have been true. What can the company possibly say here that should change any investor's mind about how the research has shown that there is some type of fraudulent activity that may have been taking place?
Well, there's actually, to my knowledge anyway, there's no proof, right? There's been a lot of kind of suspicion and accusation and things like this, but then there's also not been proof from Supermicro against the allegations. So it's hard to really, kind of judge this one until we see what happens. I mean, it is like if you look at the number, I see your point, like we're talking about a company that could have fraudulent information and we're looking at their numbers and saying how exciting they are. But if you, again, like think about what they do and what's happened in AI and who their customers are, you're talking about Alphabet, Amazon, Nvidia, it is plausible that they would have had these, massive revenues that they've reported. It's just like, what aren't we seeing, right? What's going on under the covers? And I think that, if they don't have an auditor and if they don't make that deadline, then we're kind of in trouble for the near term. At least it's going to go to the pink sheets and we'll see what happens. But either way, if there's a valid business model somewhere behind all of this, you think about leadership getting changed out, you think about new auditors coming in, new accountants coming in. It's not like the company is certainly poised to go away. We just have to figure out what's going on here.
Do you continue to trade this name if it is over the counter, if it is on the pink sheets?
I mean, I think it depends on how much of it you hold and whether or not you've sold it or not, right? You probably won't have a choice if you didn't sell going into that and it gets transferred over. But I mean, I talk to a lot of investors that just are thinking long term, and the view is that we don't know what long term is. It could take a year, it could take years for this to clean up. But if they, file some semblance of a valid report and kind of fix this, right? And it's a huge PR problem, then I think their investors will come back into the stock. But I think until you get clarity about that November 6th, we're right there, right? So we're going to know in a couple of days or less than that, less than a day in terms of like what the future is. So I don't think you'll see loads of buying today. And if it's good news, you can, always buy it afterwards. So maybe hold tight here.
Sylvia, let's zoom out and talk about the AI trade overall. We were just talking to Omar about the fact that a lighter regulatory environment under a Trump administration that could potentially be a boost here to the sector. I'm curious just in terms of specifically these AI plays, and I know you have some exposure here to some of these names. Are you expecting a bit of a tailwind here heading into 2025?
I definitely am. I also think that there was a tailwind heading into 2025 anyway, kind of like regardless of who got elected. AI is been the biggest boom of the last couple of years, ever since like the ChatGPT moment. It's essentially all the rage. Every company is investing in it. And I think, so far what we've seen is a whole lot of CapEx, right? And what we'll hopefully see in coming quarters is companies reporting, kind of the revenues and ROI that they got on their investments. But I think AI is in its infancy. Like so far, all we know about it is, are things like ChatGPT and search engines and such. But if you think about AI starting to filter down into aerospace and defense, into healthcare companies, drug research outcomes, things like, bettering GLP-1s, cancer research, things like this. Even banks, right? Better estimating credit and, kind of risk issues, both for corporate and home loans. There's just so much that AI can touch and benefit. And so I think the spending will continue. And so I think that a lot of these companies will continue to do well. And as you said, we have a lot of exposure to supercomputing, quantum computing. We think that in order for AI to actually be tangible and happen, you have to have this supercomputing, high speed data processing. And so I just think that everything from the power side of AI to the chips to, to the connectivity is going to grow.
Sylvia, just lastly, while we have you here, given the conversation around AI, I was looking at a headline from Palantir here this morning. And of course, there is also the fact that they're going to be switching their listing, potentially being able to get into the Nasdaq 100 as a result of the switch listing. But more interestingly to me was launching AIP for developers at DevCon here. What is the significance of a move like that and opening up that platform to developers for a company like Palantir?
Yeah, I think that bodes very well for a company like Palantir, right? And I think it's also bodes well for the future of AI because, there are some issues with AI that we talk about, right? And quantum computing as well. And error control is one of them, data control is another. And I think if you have, kind of open source abilities here, you can come out with some more efficient and more aggressive, better products along the way. But Palantir is another great stock. It's touching everything, part of aerospace and defense, part of the AI power play. A lot of these names like Nvidia and Palantir and even the quantum stocks, IonQ. They're really moving off of these developments and the talks of these developments.
Sylvia Jablonski, Defiance ETF's CEO and Chief Investment Officer. Thanks so much for taking the time here with us this morning.
Thanks for having me.
We've got much more ahead here on Yahoo Finance. Stay tuned. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, we've got AMAT, Applied Materials, offering weak sales guidance for the current quarter, suggesting demand for non-artificial intelligence chips is slowing. The chip maker expecting China to represent 30% of its top-line performance in the first quarter of 2025. That's down from 32% in the third quarter of 2024. Applied Materials also anticipating a 28% drop in display revenue due to lower Chinese demand. Shares down 6%.
The U.S. Commerce Department finalizing its $6.6 billion subsidy to Taiwan Semiconductor under the CHIPS Act. TSMC is set to expand its semiconductor production in Phoenix, Arizona under the agreement. The deal also including up to $5 billion in low-cost government loans. This coming just weeks before President-elect Trump, who has criticized the CHIPS Act, is set to take office.
Meanwhile, Samsung announcing a stock buyback program worth $7.2 billion to begin over the next 12 months. That's according to a regulatory filing, and this coming as the firm's investors voice concerns about competition, worrying that Korea's largest company may be falling behind when it comes to artificial intelligence.
That does it for the morning brief, but keep it right here on Yahoo Finance. Brad and I are sticking around for another hour for Catalyst. That's coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
Yeah, first up, traders pare back bets on Fed rate cuts amid dovish commentary from the Fed. We break down the comments and get the latest read on the consumer.
Plus, we'll hone in on China's consumer as e-commerce giant Alibaba beats profit expectations. We got those details ahead.
And we push ahead to Nvidia's earnings out next week as investors turn their focus to the AI chip giant.
President-elect Donald Trump's victory and hotter than expected inflation may be complicating the Fed's path forward on rates. Here with the latest commentary that we're getting from Fed members, including Fed Chair Jay Powell, is our very own Jennifer Schomburger. Hey, Jen.
Good morning, Shauna. Fed Chair Jay Powell and other members of the central bank this week said they still continue to expect cutting rates, though Powell said that the central bank is not in a rush. Earlier this week, Minneapolis Fed President Neil Kashkari told me in an interview that it would probably take an upside surprise to inflation not to cut rates in December.
If we saw inflation surprises to the upside between now and then, that might give us pause. If the labor market, it'd be hard to imagine the labor market really heats up between now and December. There's just not that much time. I think there'd have to be a surprise on the inflation front to change the outlook so dramatically.
October inflation readings out this week showed little progress toward the Fed's 2% target, calling into question inflation and how deeply the Fed will cut interest rates next year. But Powell reassured investors, saying Thursday he continues to expect inflation to come down to 2%, but added, quote, albeit on a sometimes bumpy path. He noted he expects fluctuations in core measures of goods and services inflation, excluding housing, within their recent ranges, but will be carefully watching to ensure they do so. Powell noted the Fed is moving over time to a more neutral policy setting, but said, quote, the economy is not sending any signals that we need to be in a hurry to lower rates. Take a look at Fed funds futures this morning, which have been very volatile this week. Right now, pricing in just about a 58% chance of a rate cut in December, down from odds of better than 70% before Powell spoke on Thursday. Meanwhile, Powell was asked under what circumstances he would consider continuing to serve on the Fed board after his term as chair ends. Take a listen.
I'll certainly serve to the end of my chair term, and that's really all I've decided and all I'm thinking about.
This afternoon, I'll be speaking with Richmond Fed President Tom Barkin. Guys.
All right, Jennifer, thanks so much. Appreciate it. Let's turn to the market reaction to Powell's comments and retail sales here as Treasury yields are ticking higher as traders rethink bets on Fed rate cuts. Joining us now for more, we've got Chris Rupke, who is the chief economist at Forward Bonds. Great to have you here with us this morning. So as you kind of look at the overall inputs into the economy right now and really start to think about how the Fed may also be positioning itself, what are some of your anticipations and the corollary to where the bond market may move as a result?
Well, it's interesting. I mean, they've given us a game plan. We've never had a schedule for rate cuts. Usually the rate cuts that we've had are, emergency type cuts in a recession or a pandemic. But this is the first time they've put out a forecast showing rates going down to 3.5% next year. But that's kind of being called into question right now. I'm a little worried when Fed Chair Powell says there's no hurry. It makes me think they're a little bit taken aback by the speed of the Trump administration hiring people and talking about what they're going to do in terms of fiscal stimulus, spending cuts, et cetera, tariffs. Maybe they're a little bit worried, Powell, even though it's too early to judge what is ultimately going to come out of the new administration.
Chris, what are your expectations for growth next year?
Well, that was interesting. Powell came up to my number. Well, he said yesterday that the economy right now is running 2.5%. So given the strength of retail sales today, there's no hesitation on the part of consumers right now. All this uncertainty, there's been hurricanes damaging, there's been strikes, the election uncertainty, as I said, nothing has slowed them down. In fact, right now, retail sales is running even faster after today's data. It's running 3.7%. A month ago, we thought it was only running 1.2%. That's in the fourth quarter. So what that means is the economy is probably going to run 2.5% this year, with GDP 3% in the fourth quarter. So that's important. Remember, they always say, watch the Fed forecasts. If the forecasts need to change and they get it wrong, then maybe policy is going to have to change or be different as well. And right now, the Federal Reserve is looking for only 2% growth, 2.0% growth in this year. And growth is running 2.5%, much stronger. So maybe that's part of the reason why he's saying they don't need to hurry.
I mean, Chris, what is part of that consumer resiliency? Is it people like me who say, all right, I can't buy a house right now, so I might as well just buy some new shoes. That'll make me feel good. And if ultimately the goal is for the Fed to pull off this soft landing, can that soft landing be orchestrated without or with the housing market staying the way that it is right now?
That reminds me of the before the Great Recession with Bernanke at the helm of the Fed. He continually said the weakness in the economy was confined just to the housing sector. And then, of course, everything blew up and we had the biggest recession since the Great Depression. Right now, similar. Housing is down in the dumps, especially existing home sales. New home sales have picked back up a little bit. But, because 10-year yields have moved back up, mortgage yields are not going to come back down to provide relief or a boost to housing sales. So, yeah, it's kind of an interesting time. The economy looks pretty strong. The only weakness is housing. And so far, that weakness hasn't even translated into people buying less furniture or appliances and things like that. I was really surprised that there is a bit of a services spending component in retail sales, which are mostly goods based. But, bar and restaurant sales were fairly strong, both in September and in October. So the public isn't staying at home. They're venturing out. There seems to be no fears about the outlook.
All right, Chris Ruffke, Forward Bonds, a chief economist. Thanks so much for joining us here this morning. Let's take a look at some of today's market headlines to start the hour, sponsored by Tasty Trade. First up, the major averages. We've seen a bit of a reversal here the last couple of trading days. Today, we're trading once again to the downside. You got the Dow off just around 272, the S&P and Nasdaq also under pressure. You got the Nasdaq, the worst performer of the three. Flipping over to the bond market, a bit of an uptick here in yields following that retail sales print that we got out before the bell this morning. The 10-year now right around 449, just shy of that 4.5 level. And taking a look at the oil market here, heading for a weekly decline. You've got Brent off just about 0.5%, as well as crude trading just above $68 a barrel. Keep right here on, finally, sorry, let's take a look at Bitcoin. We almost forgot about it. We have to take a look at Bitcoin here following the massive run that we've seen, but giving back some of those gains once again today, trading just under 89,000. Coming up, we're taking a look at today's trending tickers. We'll give you the news behind those moves. That's next on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Now let's make some money and get a lot smarter. I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to living not so fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains, world for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. That's with Yahoo Finance's trending tickers page. First up, Nvidia is set to report third quarter earnings next week, rounding out the Mag 7 this earnings season. There's a lot riding on this report, given the recent momentum that we've seen in the stock. Dan Halley joining us now for more on what to expect. Dan.
Yeah, Shauna, this is obviously the biggest announcement for this earnings quarter. I mean, it can't be overstated how important Nvidia is to tech and the broader landscape as far as AI goes. So let's just kind of give you a rundown of what's happened in this quarter. They've eclipsed Apple as the largest company by market cap. They're now ahead of Apple still, so we'll see how long that holds out. They've also had a number of kind of ups and downs as far as we've heard with regards to potential tariffs. It's obviously been an ongoing conversation. Some experts I've spoken to say that if Trump levies tariffs against China and Taiwan, which is something that he had mentioned prior to the election, that it could be a big problem for Nvidia or Nvidia's customers. But let's go over some of the numbers real quick as far as what we're expecting. For the quarter, we're looking at potential revenue of $33.2 billion. That would be up from $22.1 billion in Q3 last year, or an 83% year-over-year increase. EPS is expected to be 74 cents, up from 40 cents in the same quarter last year. And that's an 83% year-over-year increase. And the biggest part of all of that, obviously, is NVIDIA's data center business. And that's expected to be coming in at $29 billion versus $14.5 billion in the same quarter last year. That's 100% year-over-year increase. And then NVIDIA's kind of second banana now, gaming, is expected to come in at $3 billion. That's up from $2.8 billion, so just a 7% year-over-year increase. And gross margin, they're expecting it to be 75%, and that's a 0.04 year-over-year increase. So investors are obviously expecting or hoping for a beat and raise scenario. That's been kind of NVIDIA's MO. I think one of the things to keep in mind, though, is after the prior earnings report, we saw NVIDIA's stock price drop. Now, there's a few things you could have attributed that to, whether that's people just profit taking or disappointment on the beat and raise, the raise either not being as much as investors wanted or the beat overall not being as much as what investors had wanted. And when you're going from beating by 200+% in revenue for the quarter to 100+%. I mean, you know, beggars can't be choosers, but I guess in this case, they can be. And so I think one of the big issues that investors are going to be wanting to hear about on the earnings call from Jensen is the status of Blackwell. That's the most advanced chip that NVIDIA has that they're rolling out. There were previously reports of delays, and then NVIDIA said that everything's sorted out and all good. And so we want to find out more about what's going on there. You can expect investors to ask about when orders are going out, if orders are going out, and if they're reaching the customers, and then what the volume looks like of those shipments, if they're going out and when they're going out, if it's more than expected, and what that looks like for the prior generation of chips, the Hopper line of chips, which have continued to do extremely well. And I think one of the things to point out is, you know, the exact market share that NVIDIA has isn't really tied down to a single number. It's kind of a broad estimate, but it's anywhere between, I've seen 70 to 95+% of the data center market when it comes to GPUs. So they're really continuing to dominate. And if you look at the price of something like AMD shares or Intel shares. AMD is its closest rival. AMD, let's see, they're at about down 7% on the year. You look at Intel, they're down more than 50%. Obviously, a lot more going on there at Intel than just data center business, their whole turnaround story. But for the year, Nvidia continuing to just crush with up 188% year to date so far. So it's going to be a really interesting story when we get the earnings report. As I said, there's going to be a lot of lookout for what's going on with Blackwell and the shipments there. And then any kind of conversation that Jensen may or may not have with regards to potential tariffs from the Trump administration. Obviously, everybody's wondering what that means for various companies, and for a company like Nvidia, with China and Taiwan both in play, it'll be especially important.
Yeah, absolutely, Dan. We've seen a lot of animal spirits emerge even this week, despite the stock taking a little bit of a breather coming into next week's report. We will see exactly what that move looks like after the report drops next week. Dan Howley, thanks so much for teeing this one up for us. Appreciate it. Next up, let's talk a little Tesla and Rivian. They're both on the move here today, but in different directions. Tesla higher 1%, Rivian lower 4%. After falling yesterday following a report that President-elect Trump plans to end an EV tax credit. Now, according to Reuters, the Trump transition team has been discussing ending the $7,500 subsidy meant to encourage consumers to buy electric vehicles. And as we're thinking about some of the other elements of the broader Trump trade and what's being faded as well right now, vaccine makers, they're feeling the effects of Trump policies falling as he appoints RFK Jr., or at least puts forward RFK Jr. as the name to lead the Department of Health and Human Services. RFK is a prominent vaccine skeptic, and there are concerns that he could elevate an anti-vaccine rhetoric here. And there you're taking a look at many of the vaccine makers' stock in decline, continuing a decline that started yesterday after this news crossed just about afternoon. So ultimately continuing to see how investors are thinking about what these appointments and what these names that are being floated right now, what they could potentially mean in terms of their own propensity to even grow the businesses out, especially for these vaccine makers at this juncture, if there were any more of that rhetoric that were to be layered on as well.
Yeah, I think it's safe to say that there will be more of that rhetoric if, in fact, he is HHS secretary. I think this is concerning on many levels, but putting that aside and just taking a look at Wall Street's reaction, I think that says it all, just in terms of what ultimately this could have, the impact that this could have on the industry, and the implications are potentially far-reaching. You have RBC out this morning talking about the fact that this adds a considerable layer of uncertainty and challenging investability until there's greater clarity on the likelihood of him actually gaining this role. So I think that is the one area where there is some uncertainty about how likely he is to be able to be appointed in this position. TD Cowen saying that they continue to see confirmation for Kennedy as unlikely, but they did note, though, and this is a trend for some of Trump's potential nominations here, that Trump could use a recess appointment to get him into office here. So again, that is a concern. You're seeing that reflected across the board when you take a look at a number of these vaccine makers, when you take a look at a number of these biotech names, just in terms of the far-reaching impact that this could have, more broadly speaking, on the healthcare sector. So you're seeing all of these stocks, or many of these stocks, under a pretty significant amount of pressure today. So, of course, we will continue to follow that as well. All right, let's take a look at Alibaba missing second quarter revenue estimates, but beating on profit. Weak consumer spending in China weighing on the e-commerce giant. One bright spot was the company's cloud business revenue. That was up 7% from a year ago. We want to bring in Brian McCarthy. He's Macro Lens Managing Principal and Chief Strategist. It's great to have you back here. So talk to me about these results. I guess maybe a bit encouraging. What is your read?
Yeah, decent results for Alibaba. The stock's on a bit of a roller coaster this morning, which I think is sort of a microcosm of the issues that the stock faces. So the market liked the results, traded up about 4% in the pre-market. As you just showed, it's now down almost 3%, sort of getting dragged back with the broader market. So the market liked that 7% earnings growth in the cloud segment, which has been a bit of a struggle for Alibaba. And that's viewed as showing some tailwind from AI spend in China. China. Market liked that quite a bit. Their international business shows very healthy growth, up 29% year on year. It's really the one pocket of strong growth within this company at this point. But for perspective, that international business is about a third of the size of their domestic e-commerce business, which was basically flat. And I think that's the root of the issue for this stock, which is that its core business is in a highly competitive sector in a market that is beset with very, very serious macro headwinds.
What do you make of some of the bigger money that have been talking about and praising some of the names in September and October at least, names like David Tepper, names like Michael Burry, who are now fading some of their position within names like Alibaba?
Yeah, the stock is very cheap. So we're trading at about 10 times forward earnings, something like 25% of the market cap in cash. So it's a very cheap stock, but it's basically been a market performer relative to the Chinese indices over the last couple of years. I expect that to continue again because of the struggles in its core business in a market that's really competitive and not really growing. And I'm very bearish on the Chinese macro economy. As you know, last time we spoke a few weeks ago, I was bearish on the outlook for aggressive fiscal stimulus. We, in fact, did not get aggressive fiscal stimulus. The data we get from these big hedge fund managers is a little lagged. I would assume they all got the memo with the MOF, the Ministry of Finance press conference last week out of China, that there's nothing in the way of aggressive fiscal stimulus coming. So I would expect these hedge fund managers who had been very bullish on this sector to be, reassessing as we speak. Because, of course, the other development that's happened since, we last spoke is that we had an election here in the U.S. And it looks like President-elect Trump is pretty serious about enacting tariffs, both broadly at a 10 or 20% level, but more aggressively against China. And frankly, I had thought a month or so ago that might be something he would back burner out of respect for, the risks it imposes on the economy. But those are not the signs. The signs we're getting is that this could come out of the chute. But we will get a big sign with a possible Treasury announcement later today.
And if it is Lighthizer, how probably, not only Treasury, but if he is, then trades are, lots of names are being floated for Treasury Secretary. How problematic then is this for China?
Yeah, I anticipate him to get this trade czar role. It's something I've been saying for several weeks. Treasury doesn't really suit him. USTR is not a promotion. And from all accounts we've gotten in the press, he is really central to the formulation of the broader economic policy within the administration. And what's caused some friction for Scott Bessent, with the betting markets tightening up, a lot of stories about Howard Lutnick making a push for the job, is that Bessent has been lukewarm on tariffs. Even the op-ed he wrote for Fox today was, tariffs are a negotiating tool. Let's bring them in gradually. Where, Lutnick's approach has been, if the boss wants tariffs, I'm for tariffs. And I think that what we're going to get, I think Bessent will probably get the job. He's being, flying down to Mar-a-Lago for a meeting today. If I had to guess, he's being told, Bob Lighthizer is running my trade policy. I don't want a Treasury Secretary that's causing friction with what we want to do in that space. Are you okay with what we're going to be doing on tariffs? I need to know you're on board. I expect Bessent will say yes, but we'll see. But again, if Lighthizer gets this trade czar role, watch out. It means, big time tariffs are coming early next year. I think the market is really underestimating how destabilizing this could be for the U.S. macroeconomy, and it's incredibly damaging for China. They really have no answers to that kind of policy.
Yeah, we tried to have a lot of conversations around that leading up to the election as well, and now post-election with many of the leaders who are running companies that have the largest exposure as well to some of those risks. Most notably, as we think about those companies, where and how do you expect that to net out for U.S. companies that have the largest revenue exposure to China?
Yeah, so they're caught in the crossfire, of course, in what is going to be a trade battle that's going to heat up inevitably. There's some question as to whether there will be an attempt to engage China in some kind of negotiations. I think they're over that. It didn't go so well the first time around. China did not adhere to its phase 1 commitments. So I'm not sure there's any point in even having negotiations. So this could proceed pretty quickly to, we're doing the tariffs. If you want to prove to us that you deserve lower tariffs, do something in that realm. And China will probably make life miserable for U.S. multinationals doing business in China. I think that's a very real risk for those names.
Brian McCarthy, MacroLens Managing Principal and Chief Strategist. Thanks so much for taking the time here with us.
Thank you.
Coming up, everyone, we're diving into President-elect Donald Trump's cabinet picks and their impact on the business world.
President-elect Donald Trump saying he will not tap JP Morgan CEO Jamie Dimon for a position in his administration. The president-elect posted on Truth Social that he respects Dimon and thanked him for his service. This coming as Trump has announced multiple appointees to his cabinet as he prepares to take office. Here to talk a little bit more about who makes up the administration so far, we want to bring in Bill Kristol. He's a Bulwark editor at large and host of the podcast Conversations with Bill Kristol. Bill, it's great to have you here back on Yahoo Finance. Let's start with Dimon, and then we can work our way into some of the appointees so far and what we do know. Jamie Dimon was also asked about this during a recent conversation yesterday. He talked about the fact that he hasn't had a boss for 25 years. He's not interested in getting a boss right now. I don't think it's a big surprise that Dimon is not going to be in this administration, but I'm curious just your reaction to that thought and the words that we did hear from Trump.
I think Trump is showing people that he's in charge. He doesn't care what the establishment thinks. He's willing to stick it to a major establishment figure and kind of humiliate him a little bit, even if he didn't want the job, by making it seem that Jamie Dimon wanted the job and Trump was saying no. I very much agree with your previous guest, Brian McCarthy. The markets are underestimating how radical Trump can be, how much he wants to show that he has personal power, and he wants to, remove any sources of opposition, certainly in Congress and the Senate. We see that with his appointments, I think. Was to kind of humiliate the Senate Republicans and try to see if any of them will stand up to him. And so far, not many are. And I think we're seeing it here too. I mean, on the Robert Kennedy Jr. appointment, which you mentioned earlier in the show, Howard Lutnick, a major figure, I believe, on Wall Street, right? A pretty close friend. Wasn't he co-head of the Trump transition, a real figure in Trump world? Assured everyone a week before the election, I've seen the clip, you all have too, no way Robert F. Kennedy Jr. is going to be Secretary of HHS. So what are all these reassurances from Trump intimates, friends, sources, staffers worth? I don't think they're worth much.
And even as we're thinking about all of the potential appointees and by what process Trump might look to push them through as well, how are we to look at this from a perspective of what business is and how some of the CEOs that had said, okay, we're trying to position ourselves around what the outcome of this election might be. And then once it was Trump, many of them saying, oh, hey, congratulations, we look forward to working with your administration once again here. For many of them, they still kind of lack that adult in the room to be clarified once we finally do see a transition of power.
Everyone expected too much, in my view, that it would be like the first term. There'll be Gary Cohn there. There'll be a whole bunch of other grown-ups there in foreign policy, national security policy, and parts of economic policy at least. And we can talk to them and, crazy things won't happen too much. Cohn will sneak in and remove some memo putting tariffs on South Korea, sneak in and take it off Trump's desk, and the White House chief of staff will cooperate and so forth. I just don't think you can count on that this term. I don't know if the Pfizer CEO sent a nice note to Trump the day after the election, but here we are, Robert Kennedy Jr., and, vaccines can't be trusted. And I mean, if I were in another, I'm not a Wall Street person, so what do I know? But if I were in some other, part of in finance or in manufacturing and other things, I wouldn't trust all these reassurances ahead of time. And now what they'll do, I don't know. If you're a CEO, on the one hand, you have to get along, I guess, with the administration that's going to be there for 4 years. So you try to make sure you have good relationships and you try to get on the inside of the crony capitalism. But I think it's, there's a lot of history of people doing that, and they're doing fine for 6 months. And then Trump changes his mind about something, and suddenly they're on the outside, right?
So you have Marco Rubio, Secretary of State, Matt Gaetz, Attorney General, the list goes on, Pete Hegseth, Defense Secretary. We talked about RFK Jr. now, HHS potentially. Lots of questions about who exactly is going to get through, who is not. What is the biggest risk in your mind, given the appointees that we've seen so far? Is there one that maybe is a bigger risk for the economy? Not only for the economy, obviously it stretches a lot further than that, but that investors, that our audience should be aware of, and why?
So I think in the whole picture is a risk, because it shows he's not constrained the way he was 8 years ago. He wants to have personal and arbitrary power, and he's going to put people in who are either very weak and not fit for the job, I would say. Someone like Pete Hegseth at Defense who will do whatever he says, or he wants to put people in who have kind of radical views, will also do what Trump says, but will also shake things up and keep people on their heels, and that's very much part of Trump's playbook. It was his playbook in business. It's his playbook as a politician. No one gets too comfortable, right? So I personally, as a national security person, I think Tulsi Gabbard is, irresponsible beyond belief, pro-Assad, pro-Putin. I don't know that she'll get confirmed. Gaetz at DOJ, there's going to be an exodus of civil servants there. Who knows? I don't know. For now, we kind of assume they're not going to go after individuals in the media or in business who cross them. I don't know, 6 months, 12 months, 18 months from now, as things get normalized, I'm less confident. So I'm very much on the alarmed side, both in terms of the rule of law, in terms of stable economic policy. I very much agree with Brian McCarthy about tariffs, which I've also kind of assumed is the one thing Trump would back off on, because all of his donors and all of his friends in finance are going to have been telling him, you can't really do that. But you know what? He may just want to show I can do what I want. And maybe eventually he backs off if the markets take a hit and he doesn't want the stock market going down and so forth. But I think the degree to which Trump wants to show he is in charge and he's not listening to anyone from the establishment and they can't take him for granted, I think that's been underestimated.
Do you think that the party would still support these picks and support him even through the very radical picks that have been put forward thus far and the reaction that we could see on an economic basis?
So I think that's a huge question. That's why, for me, what happens in the next 2 months is very important. People have been focused on January 20th, what's going to happen. What happens with these picks is important. It's a different world if Republicans stand up and say no to Robert F. Kennedy Jr., no to Matt Gaetz at Justice, no to Tulsi Gabbard as Director of National Intelligence. Then I think people think, okay, then Republicans will have done that a couple of times and they'll be used to guarding the guardrails and exercising some power, and Trump will have to back off some. But this is very important. If they all sail through, I think Trump thinks I've got them all in my pocket. And they can whine to me, and they can get some CEO to call me about tariffs. They can get some other defense contractor to call me about something else. And I'm not listening to any of them. So I think this next 2 months is actually much more important than people have sort of realized. Everyone sort of dates the Trump administration, obviously correctly in a legal sense, from next January 20th, 2025. But what happens in this transition in terms of the nominations and the confirmation and the degree to which Republican senators have no willingness or do have a willingness to stand up. And also not just senators, people on the outside. Do retired national security officials say Tulsi Gabbard's totally inappropriate? Do business types get upset? You know, what is the position of Pfizer's CEO on the confirmation of Robert F. Kennedy Jr.? I mean, I'm not picking up Pfizer, very fine company and all that, but what is the position of the trade associations? What's the position of the Business Roundtable? They think it's all just fine to have someone like that running a massive department who thinks all the vaccines are a fraud, basically? I don't know. So I think a lot, what happens in the next 2 months is very important.
We didn't even mention the potential conflicts of interest with Elon Musk. Bill Kristol, who is the Bulwark editor at large, thanks so much for taking the time here with us today.
Yeah, thanks.
And we've got a quick programming note for you as well. Check out Capital Gains, Yahoo Finance's look at how U.S. government policy will impact your bottom line long after the presidential election has closed. And as we are past that, we're now looking at January. Tune in to new episodes every Friday, 12 p.m. Eastern, wherever you get your podcasts. Coming up, Netflix is going live. We get an analyst's take on the streaming giant's live programming strategy next on Catalyst. Do we have any Mike Tyson or Paul Vio? I don't know. We'll see.
Stick around. Netflix is officially taking a swing at live sports. The company will be live streaming the highly anticipated boxing match between social media influencer Jake Paul and former heavyweight champion Mike Tyson. Our very own Alexander Canal has more. And Allie, despite what I initially thought, people do care about this.
I've been seeing it around my social media. They met, for the matchup. I'm not a huge boxing watcher, but Brad, you were even saying that you might go to a bar and watch it. I mean, it's getting attention. It's getting attention, and it comes as Netflix has really been leaning more into live events, not just with the sports aspect of things. Obviously, they had the NFL games on Christmas Day coming later this year, but they also have been doing live comedy specials. They did the live Tom Brady roast, so they're getting more into this live content. And really, the purpose of this is for the advertising tier and really to fuel more ads onto the platform. Netflix just reached 70 million global monthly active users. They revealed that on Tuesday. It's been 2 years since the platform launched. That's 40 more. That's a jump from the 40 million users the company revealed in May. So a 75% jump there. So people are signing up for the ad tier. That's encouraging to those advertisers. In that blog post, they actually said that events like the Jake Paul Mike Tyson fight have been driving more fandom and conversation, which our advertisers love. So that's exactly what we've been doing. So that really is the purpose of it. And I think we're going to see Netflix lean further into live events as they further push into the advertising world. And also they just want to get that engagement up. And clearly, if you want to see this fight, you need to watch it tonight so you can get in on the action.
Do bars have it since it's on Netflix?
It probably will.
Yeah,
Probably.
if you have Netflix, you got it.
Yeah.
It's one of the easiest carried fights of all time.
Can you just watch it at home?
Yeah, I could.
But you're just going to go out to a
and
bar.
this was rescheduled, remember, from the summer. So it's been a long time coming. They've been pumping it out. They've been promoting it. Everyone seems pretty bullish on it. I don't know. Who do you got winning?
I have
It's
Mike
hard
Tyson
to go
based
against
on
Iron Mike.
absolutely nothing.
I mean, here is the thing. Okay, all right,
You have the favorite.
and I'm going to try and tie this back into a business analysis. So for Netflix, great, and that is the extent of the business analysis. Iron Mike Tyson is a trained professional fighter, and he is coming out of essentially retirement. I think he's got a weed company now. I think he's been in at least 3-4 movies at this juncture. And so multiple. We'll couch it at multiple movies at this juncture. And so he has clearly gotten on to a different phase of his life. And then you get a cash haul that comes forward like this. Why wouldn't he do it?
Right.
Now he is double Jake Paul's age, whichever Paul is fighting. Jake Paul, okay,
Yes.
cool. I lose track sometimes because both
There's
of
a lot
these
of Pauls
guys,
out there on
I just wonder if they get tired of being called an influencer that is fighting. So at some
And
point
Jake
they're
Paul's
going to
been
have to
doing
fight
a lot
somebody
of
real.
boxing. Yeah, true.
Yeah, like a real active professional
So who do
fighter.
you have?
It's a great question.
It sounds like
Sounds
they're
like you're
leaning
pretty
more.
split.
Yeah. I can't tell.
I mean,
we're gonna have to check Ben on
It's a
that.
young person fighting a very old person who was very good at their sport
Alright,
for
so
a very long
so
time.
then you're going Paul.
Well, so
It seems like you're going Paul.
I'm split. It's a split decision, honestly.
All right. Odds are 50-50.
From the sports science of it all, I guess.
Well, we're going to put the question to our guest, maybe.
Yeah,
Maybe he has
just
a
tweet at us. If you're upset that I gave you a non-pick, at the Brad Smith, at Yahoo Finance. Just light it up. Allie, thanks so much.
Of course.
Allie.
All right. Join us now for more on Netflix's live sports strategy and the broader streaming landscape. Michael Pachter, who do you got of Wedbush Securities, Managing Director of Equity Research?
Tyson with a knockout, and I'm
we
watching
go.
it as well because it'll be more fun with other people. So I'm with you.
All right, exactly. You're with me on this one. So, all right, all these things considered, when you think about what this means for Netflix and making sure that they can capitalize on events like this and use this as an inflection point for some of their other major sports ambitions, because they also have, even more fights that are going to be coming to the platform with the tie-up with TKO. You know, how does this serve as a jumping off point for that?
I mean, Allie nailed it. They're doing this more because we're talking about it. So, you're covering it. I think that there's two types of live events. There's live events where the content has no value as soon as the event is over, like last night's football game. You're just not going to watch it again. You know who won. And same with this fight. Tomorrow we won't care because we'll know who won. Then there's other live broadcasts that actually has ongoing value, something like The Voice or Watch What Happens Live on Bravo that can be rebroadcast on Peacock. And if you haven't watched that, you're fine watching it again. It doesn't really matter what the cat fight was in the live event. In fact, you might hear about a cat fight and you might decide you want to watch it. Alexis was a bitch on something, so you want to watch it and find out what happened. I think that what Netflix is doing is a mix of both. So we don't really care about the outcome of WWE SmackDown. I think that's Friday night, or Raw on Monday night. I don't think we really care because we know it's all staged and it has huge archive value, but the people who do care will watch it live. And Ali said it perfectly. What broadcast does for Netflix is it allows them to advertise. And the open question is, will they advertise on the rebroadcast? When things are archived, if I'm watching to catch up on this season of WWE, if I'm watching the last 10 weeks, do they advertise on that programming? And I think they do. The part that I think she missed, and I think this is actually more important for the stock, is that the 30 million ad-supported customers that they added aren't really additions. They're really people who traded down. They didn't add 30 million people in the last 6 months. We know that. They added like 5. So, what happened? People aren't churning out, and that matters. So Netflix has found a way to keep churn super low. And somebody who says, I'm not watching Netflix that much, I can't afford $15 a month, I can afford $6.99 and I'll tolerate a few ads. 30 million of those people signed up in the last 6 months to do that. That's huge. So if churn declines at Netflix and they can retain the customer, and then ad sales go up and they can replace the dollars lost, they can capture another $9 or $8 per customer from advertising, they're golden. And that's what's happening. And that's why the stock is working.
Michael, how big of a catalyst do you see these initiatives, them being for Netflix's stock going forward?
I think that they really have to abandon the ongoing live events. Like, they shouldn't bid for Thursday night football or Sunday football. I mean, that's just something that would cost them billions of dollars. And, first of all, the NFL would be stupid to put that on Netflix. But bidding for things that are kind of staged like WWE, pretty smart. British Baking Show, we don't really care what the outcome of that is. It's entertaining, even if you're watching 5 years ago. World Series of Poker, they can broadcast stuff like that and do really, really well. So yes, super important because it supports the ad-supported option. It gets ad revenue from the subscription people as well. Ad-free, I still have to watch ads. This on Thursday Night Football, you had to watch ads on Amazon Prime. So, it's a smart move because it's going to bolster revenue without really upsetting their customer base.
Michael, as you think about what the return on investment for some of these major contracts should look like, how much are you comfortable with Netflix bidding to spend on whether it be live sports or other major live events, because they're trying to create that around, even reunion episodes of Love is Blind in the future, I imagine. Look, they got me on that. So, it's going to bring in more viewers, but on the spend basis, what are you kind of looking at and earmarking as this seems like it's too exorbitant or this seems reasonable for how much they would get in return?
Yeah, they're taking little tiny nibbles as opposed to going and swinging for the fences. So, yes, Love is Blind, but that's cheap. Comedy specials, not Chris Rock, that's really cheap. They're not bidding on the NFL, the Sunday games, 2 games a year, okay. They're not bidding on the NBA, Amazon is. They're not bidding on Thursday Night Football, Amazon is, and Peacock is. So I think that the big broadcasters and the big tech companies who have hundreds of billions of dollars more than Netflix has to spend are spending it. I think the sports leagues are idiotic going for the short-term, solution and fragmenting their rights and alienating their customers. When people find out they can't get a playoff game, because they don't subscribe to Prime, that's just terrible. But Netflix is managing their balance sheet really, really well, and they're taking tiny, tiny bets. The biggest bet they made is WWE. And even that, they're going to make it up in ad revenue. So it actually turns out to be a great deal because they're paying WWE for global rights, and they're going to have 200 million households outside the U.S. that have never seen a WWE wrestling match. They're going to actually probably hook 10 million people in weird places like Slovenia and Ghana who have never watched WWE but are paying to be Netflix customers. So I think it's really, really smart.
Michael, I want to pivot real quick. You're the perfect person to ask this question. Stay in the streaming realm, the media realm, but focus on Disney. Reports out this week that Disney's expanding the CEO search for Bob Iger, reportedly interested in EA's Andrew Wilson. Does Wilson make sense for Disney, and why or why not?
Andrew is probably 49, I think. He's not 50 yet, I don't think. 10 years as as EA CEO. He invented FIFA Ultimate Team, so he invented the ongoing recurring revenue sports business at EA. They have turned that into, roughly half of their overall, $7 billion of revenue. So he's really a good CEO, really gets sports. EA has all the big sports. They don't do well in basketball. They're great at college football and NFL football and soccer. And I think ESPN has always hoped to branch out and do more than just subscription service. So I think, if you merge the two, the guys who do the video games and interactive and ongoing, Ultimate Team is like fantasy sports. So really good at that. Merge that with ESPN fantasy football and the ESPN broadcast. I think EA makes a lot of sense for Disney to acquire. Disney hasn't done it because they suck at video games. They've shut down video games 3 times. They've tried it 3 times and failed 3 times, the last 2 under Iger. So I think, this is an indication that the Disney board really is interested in video games. I think that Disney board is looking for somebody 20 years younger than Iger, and they've got that in Wilson. They're looking for an accomplished CEO. They've got that in Wilson. So I actually think it happens. I mean, again, they may find somebody else. There's always guys out there like Jeff Shell who would be fine to run Disney, but I think the right guy is Andrew Wilson. So I think that deal happens.
All right, Michael Pachter, great to have you. Thanks so much for taking the time to join us here this morning. We've got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance. Take a look at the major averages. We're seeing further declines here as we wrap up the trading week. You've got the Dow off just over 300 points right now. The S&P off about 1.2%. The decline in the Nasdaq 2%, the biggest since October. Be right back with Wealth.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, how commodities are responding to the potential impact of tariffs on a U.S.-China trade. We discuss that with strategists. And 4 tips for year-end financial planning. We dig into the moves that you need to consider before the new year. Plus, we'll air the 3rd installment of a 4-part series exploring the challenges of succeeding in the small business arena. Yahoo Finance sat down with one premium chocolate company that's looking to grow its business while juggling a spike in cocoa prices. Plus, a programming note here. Yahoo Finance has teamed up with former Congressman Patrick Murphy and veteran investor Dan Kunz for Warrior Money, a new show that's dedicated to uplifting the financial well-being of military veterans transitioning to civilian life. That premieres today, 12:30 Eastern Time. Well, as we get into everything during today's show, first we must take a look at some of the market action. We're 90 minutes into the start of trade. Stocks right now fallen, as Alicia Keys would say, on track for a losing week as the post-election rally stalls and the Fed said that there's no hurry to cut rates. Here with me now in studio, we've got Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. You've been watching commodities and the impact of potential tariffs. How is that changing some of your strategies as well right now, Katie?
So one of the big things that we've seen this month is you've definitely seen a reduction in price of a lot of base and precious metals, in particular with the impact of the election suggesting that there's going to be pressure on these markets. So you might see more sort of movements in those commodities. Aluminum in particular was way up today because of some Chinese response to tax rebates. So there's a lot of volatility there. I think the biggest asset that was fun and interesting to watch has been gold. Gold has been on a tear all year.
Right.
And this month, with the change and with the recent election results, you actually saw gold pulling back.
Right.
Some of it may be sort of the pressure on metals, but some of it may be also just how much you've seen the US dollar so incredibly strong lately.
And even with the rebound that we're seeing today, yeah, the broader chart here in gold futures, as our viewers are taking a look at here on the screen, over the past 5 days down by about 1.4%. Do you think that this is because of some of the risk on tenor that has really emerged, especially as seen through some investors who have flocked towards what has commonly become known as digital gold versus physical gold?
Oh, that's totally, exactly. So Bitcoin being as high as it has been, just sort of if you think about it as a substitute for gold, with dollar also being very strong recently, gold has been under pressure, but I think it's also partially the narrative of tariffs and any metals which could be used in production with potential trade tension.
Katie, we're going to fix your mic real quick here as we want to get this audio right for our viewers out there. So stick with us for a hot second. In the meantime, though, we've got Yahoo Finance's own Julie Hyman standing by as Trump administration appointments have been coming fast and furious this week. Julie, what are you seeing?
So the appointments have been coming, and the one that's been getting a lot of attention has been DOGE, right? The Department of Governmental Efficiency, headed up by Elon Musk and Vivek Ramaswamy. We don't know what it's going to do, but we know that its goal is to cut government spending. So I wanted to take a step back and look at government spending and also look at why, in the view of some, that government spending is an issue. So let's break down first and look at what government spending has been. And as you see, it's been going mostly up. We had, of course, this spike here that happened around the pandemic and the stimulus that was pumped into the U.S. economy, then coming back down. But still, the trend line remains that is going up and to the right. So the last fiscal year for the federal government, the spending was around $7 trillion. And that fiscal year, by the way, is October 1st to September 30th. So we're already in fiscal year 2025 as far as the U.S. government goes. So that's the spending that we have seen. Where are the increases in spending coming? Well, the Committee for Responsible Federal Budget took a look at this issue. We know that the bulk of the U.S. federal budget and spending goes to Medicare and Social Security. And indeed, the increases in spending on those programs comes from those two areas as well. Aging of America is one of the reasons why we see that happening. Other health spending as well. Net interest is a very important part as well, where we see that as a growing share of the spending that the U.S. does, because all of the spending that has been happening isn't just because we have that money lying around in the US. We don't collect enough in tax revenue to pay for all of the stuff that we're doing. So how do we make up the difference? We borrow. We borrow through the US Treasury market, both through short-term bills and longer-term bonds. That's where you get the federal deficit. When we bring in more than we spend, we have a surplus. We haven't had a surplus since George W. Bush. And when we spend more than we take in, that's how we get the federal deficit. And that's why you also have the increase in US debt in order to pay for all of the things that the US government does. So when we talk about the cuts to spending, the impetus is at least in part because of all of this. It's also because the right side of the aisle tends to want a smaller government, more efficient government, et cetera. So is this a problem? This is something that Wall Street has really wrestled with for a long time, whether the rising debt to GDP in the United States is going to be a problem for the U.S. economy and markets. Well, Torsten Slok, chief economist over Apollo, the parent company of Yahoo, came out with a note on this very issue this morning. He concludes it's not a problem right now. He says it would be a problem if there was a downgrade of U.S. sovereign debt, of U.S. treasuries, which we have seen in the past. You have to watch treasury auctions. He said if demand was weakening for treasury auctions, that would be something to be alarmed about. The term premium, that is how much are people demanding in yield to hold longer term U.S. debt. And finally, he talks about the dollar and if we see a declining dollar. These are some of the risks and warning signs to watch if the market is getting more alarmed about the deficit. Now, as you know, Brad, I talked earlier in the week at Yahoo Finance investor Rick Reeder of BlackRock, and he said this issue is not the shark closest to the boat right now, as far as the market is concerned, but he says it could eventually be, and that also seems to be kind of the consensus out there.
All right, hate sharks unless it's Shark Week, then I'm fascinated. Julie, thanks so much, appreciate it. Let's turn back to markets here, taking a look at the major averages. Right now, stocks are lower across the board for the U.S. major averages. The Dow, the S&P 500, and the Nasdaq slipping. And still with me here to dive more on the market's activity here, we've got Katie Kaminsky, Alpha Simplex, Chief Research Strategist and Portfolio Manager. Katie, you see a pullback like this post-election. What does that signal to you?
Well, I think it's more just digesting, because what we have seen, and what's been interesting to us, is going into the election, we already saw pretty strong trends building long equities. We saw pressure on bonds and higher yields. We also saw a U.S. dollar trend going into that, so that apexed and really expanded and broke out further after the election results became clear. So we've been waiting a little bit on sort of what are the results or the long-term implications for a change in policy for the U.S. And I think shorter term, things are looking pro-growth, positive for equity markets. And that's why I think you see that sentiment still being strong despite a little bit of perhaps profit taking and adjusting. But I think the longer term picture is where we have to think a little bit more about what does this mean. And I think with Julie talking about deficits, it's really about looking at the bond market and the potential for inflation.
You know, while we're thinking about the short term here, short term as next week, we have an earnings bellwether and a stock market bellwether in Nvidia that has really been the poster child for the AI trade and the thesis around AI right now. What do you anticipate for the market's digestion of growth at this juncture, especially when there's some tough comps that the company starts to face after a while, because 200% growth time after time after time again just seems unsustainable?
Definitely, and I think you've seen a little bit of market reaction related to that even this month. There's been some rotation towards favoring small cap over large cap, favoring other businesses and other sectors over tech, and that perhaps is that question about how far can this go. It is also, it's really going to depend on what we see in the numbers, especially in a moment right now where 10 stocks make up such a large portion of the U.S. stock market. That concentration risk is real because we have more concentration in today's market in firms like Nvidia than we're used to having historically.
One of the other interesting plays over the course of this year, and kind of ties back into the AI trade as well, is energy. What's your evaluation of that sector, considering how much we've heard technology companies now even talking about nuclear reactors in the future and investing in that wave of energy to power data centers as well.
Well, energy is going to be a big place to look going forward, especially with a change in administration and different policies. But if you look at how energy's behaved this month, they've actually been down. So you've seen energy prices going down. You've seen perhaps some respite right now, but longer term, energies and energy consumption is going to be a big factor in how we power AI. And so energy pricing is going to be sort of one of the commodities that people are focused on to determine what's possible and what's not.
Katie Kaminsky, who is the Alpha Simplex Chief Research Strategist and Portfolio Manager, joining us here today. Thanks so much for the time. Now, let's get to some of today's trending tickers that we're watching here on Yahoo Finance. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Nvidia. Nvidia taking a turn lower along with the broader markets today. Nvidia is on track for a losing week ahead of its third quarter earnings report out after the bell next week on Wednesday. The stock still up more than 180% in 2024. Separately, CNBC reports Elon Musk's XAI company is raising $6 billion in order to buy 100,000 Nvidia chips. And Apple could be hit hard by Trump's proposed tariffs on China. Jefferies analysts saying in a worst-case scenario, Trump's tariffs could cost the iPhone maker $256 per iPhone, per smartphone, impacting gross margins by nearly 7%. Analyst Edison Lee adding that while Apple has attempted to move more of its production to countries like India and Vietnam, only roughly 10% of iPhones are actually made outside of China. Lee also noting that in Trump's first term, Apple was exempted from tariffs. Finally, an analyst at RBC sees more than 15% upside for shares of Starbucks and Chipotle. RBC initiating coverage on both as outperform. The analyst giving Starbucks a $115 price target and further citing growth potential and margin improvement in the back half of 2025 and 2026. Chipotle notching a $70 price target, with the analyst saying that the company has a long runway for unit growth and multiple potential upside catalysts to justify its premium valuation. Those are some of our trending tickers here. We're also tracking here today Supermicro Computer, facing accounting issues causing the company to delay the filing of its 10K and 10Q reports. Supermicro now has until tomorrow to file or submit a compliance plan, or it will be delisted from the Nasdaq. That means the stock would be removed from the stock exchange. So what do investors need to know? Our very own Rochelle Akufo has more. Hey, Rochelle.
That's right, Brad. There's still time, but Supermicro Computer risks the delisting process beginning on Monday on the Nasdaq. Now, if you own shares in a company that gets delisted, you do still own them, but the way that you trade them changes significantly. So shares move to over-the-counter markets, or OTCs. Now, these are decentralized and have less regulatory oversight than the traditional exchanges, so you'll have to do more due diligence as an investor. Now, the OTC Markets Group operates 3 tiers of OTC markets with varying levels of financial standards and oversight. OTCQX is the top tier, followed by OTCQB, and then the pink open market. Now, keep in mind, these transactions go through networks of dealers who then provide quotes to brokers who then negotiate directly with each other. So, of course, with that in mind, trades like this do tend to take longer. They also have lower trading volumes and they tend to be more volatile. Now, typically, companies get delisted for regulatory violations, financial instability, or other red flags. But there's also voluntarily withdrawing as a strategy. For example, if a company wants to go private as well, Brad.
There's also news that Palantir could be switching its listing, moving from the New York Stock Exchange to the Nasdaq. Can you break down what that means for investors?
Well, most importantly, investors' shares will stay the same. It just means it's going to be on a different exchange. And interestingly, switching exchanges means that companies can leverage the Nasdaq's reputation for being an innovation hub with its focus on tech and growth industries. Plus, the Nasdaq's electronic trading system is more advanced and the listing fees are lower than on the New York Stock Exchange. Now, on the NYSE, the oldest and less volatile of the 2 exchanges, you do tend to find more blue chip companies and institutional investors. So definitely not a red flag situation to see a company move. It's sort of a strategic growth when a company moves in this sort of direction.
Yeah, coming from a work history where I did work in that line of business, certainly it is strategic on many occasions and during those discussions as well. Rochelle, thanks so much. Appreciate it. If you want to hear more from Rochelle, tune in to the Capital Gains podcast every Friday at 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Coming up on the other side of this break, we're tackling financial planning for the end of 2024. We'll give you 4 tips that you need to know before the new year. Plus, we're going to dive into the latest survey about Americans' economic outlook. Stay tuned. There's only 45 days left in 2024. You heard that right. It gives you time to get planning for 2025, but limited time at that. According to Citi, 68% of Americans have some form of financial stress, but just a third of Americans have consulted a financial advisor. Joining us now with her top tips for year-end financial planning is Kristen Bitterly, who is the head of Citi Global Wealth at Work. Great to have you here in studio with us. Good to see you. So as we think about this, I mean, it's a reminder for me that I need to do my own assessment as well going into the end of the year. But where can people get started and make sure that they are not only closing the books on 2024 correctly, but setting themselves up for 2025 the right way?
Yeah, it's so interesting because I feel like this year has been dominated by who was going to win the election, the probability of the election outcomes, trying to navigate that from a portfolio perspective, which certainly now that we have visibility into that, it has shifted from election uncertainty to policy uncertainty, which is is really more about your asset allocation and how you're thinking about investing your money. But that stat that you quoted to kick us off, that only 1 in 3 Americans, while you're stressed about your financial wellness and outcomes, at the same time, 1 in 3 has actually consulted a financial advisor. So I would say the number one place to start, if you have not started, is coming up with a financial plan. So that 66%, why have they not done it? It's generally because people think they're either not wealthy enough or that they just simply don't have the time. So start with a financial plan, and then from there, you can really get into these other things that are really important in these final 45 days.
And so let's talk about people's portfolios as well, and where they need to kind of take an assessment, take a look across their portfolios and feel where they need to either harvest losses or make sure that they are kind of setting themselves up on the gains that they have also seen correctly.
Absolutely. So 2 things. One, I would take a look at your budget for 2025. What we found, and you can look at the stats of, 6.7 trillion. I think that was this morning in money market funds. And that's just cash on the sidelines in money market funds. It is not bank deposits. And so I would take a look first at your cash holdings and say, what do I really need in terms of budgeting for the year, the months ahead? And operating cash is very different than choosing cash as an investment. And so with interest rates coming down on the front end of the curve, it's really important to make sure that you have the right cash allocations within your portfolio. The second piece is it's been a great year in equities. And so you want to make sure that, do I have any concentrations within my portfolio? Are there outsized exposures? Am I positioned now for what is a Republican government? And then taking advantage of, to your point, any losses that you can harvest or that you've done previously, and using that such that you can rebalance, be positioned how you want to, but not have that tax drag when you do that.
Kristen, I also have a heart. I've been donating a little bit this year where possible within the plan as well. And so what if you have made some charitable donations over the course of the year and making sure that fits into your budget, or perhaps you have plans to on Giving Tuesday as well for all the folks
Giving
out
Tuesday
there.
is coming up.
Yes.
Yeah, so another important thing as we face the end of the year is once you've set up that financial plan, and again, I go back to this very, very first step in terms of anticipating what is that going to look like, what is your tax obligation going to look like, and then using that for good in terms of reviewing your charitable donations. There are a number of different tools, whether it's direct donations, whether it's things like donor advised funds, and so there's ways that you can actually use it to your advantage in terms of your assessing your overall tax position, but then also direct your capital to areas that are really important to you.
Yeah. All right, so as we're closing the books on 2024, looking out to 2025, I mean, what are some of your favorite sectors or sectors that you're playing or those that you're fading going into next year?
Yeah, so I think you have to keep in mind that it's going to be policy, not politics, that are going to drive a lot of these decisions. And so obviously over the next couple of weeks, we're going to have to watch really closely in terms of some of these appointments and what it means in terms of the advisors around President Trump and what that means in a Republican government in terms of a red sweep. But what I would say is just looking at some of the high level positioning that we have, I think U.S. dominance over international, that is something that is clearly going to continue in terms of capital coming into the U.S. I think while this week has been volatile and we've seen a pullback in markets, that broadening out story, one of the stories that we haven't paid enough attention to is the fact that earnings have been really, really good Q3. Yeah. We've seen that broadening out. It's about 8% year over year. The bar was very low at 3%. But I think you're seeing that expansion into small and mid cap. One thing that I would highlight, though, is because we have seen interest rates, you've seen that 10-year spike up a lot in terms of the interest rate. I think when it comes to expanding into small and mid cap, you still need a quality bias. You want profitable parts, because if we see that interest rate really kind of pressure test some of those limits, that clearly is going to impact some of the parts of the market that could be exposed from a balance sheet perspective.
Yeah, and according to some FactSet data, if 5.3% even is where we hold at for the growth rate for the quarter and earnings growth, it would be the 5th straight quarter of year-over-year earnings growth for the S&P 500 here. Something worth tracking, something worth bringing up as well.
Absolutely.
Kristen Bitterly, head of Citi Global Wealth at Work. Thanks so much for taking the time.
Thank you.
Absolutely. Well, Americans are feeling pretty optimistic about their financial picture. According to a survey from H&R Block, 2 in 3 Americans on average expect to have greater economic opportunities than their parents, and that includes 70% of Gen Z. Here with the details, we've got Curtis Campbell, H&R Block's president of Global Consumer Tax. Curtis, good to have you here on the program. Let's start with an overview. According to the survey, why are Americans optimistic?
Right, good to see you again. So a couple things. I'll highlight 2 points. Specifically, optimism is high across income levels and generations because wages are outpacing inflation. And you mentioned this, each generation feels better off than the last. The second piece I think is really important. There's a lot of buzz about rising costs and inflation. Debt's the real threat to American prosperity. Credit card debt and student loans feel unmanageable for most generations, especially Gen X, just like me, keeping a keen eye on trying to drive up their savings and paying off loans. I remember, Brad, my wife and I struggled with both undergrad and grad school debt for many, many years. So the struggle is real.
Yeah, no, we feel that. Something that came up in the survey was side hustles. And I was particularly interested in this part of the survey because it seems like we're leaning more and more towards an environment where people are understanding and appreciating the value of having multiple streams of income here. So what did you find here as part of this survey?
It's really interesting. The side hustle thing has become increasingly more popular. And we expect that trend to continue to grow. In the data that we looked at, Gen Z, a lot of them opt for creative, new ways to create income, especially in the way that they prioritize home buying, better health and wellness, and travel. It was really interesting. The number one side hustle across all age groups was answering surveys, followed by driving for an app like Uber and Lyft, and then testing and reviewing products. It's really interesting.
I also want to focus in here on Gen Z. I mean, already contributing to the workforce. Can we talk about how they are viewing financial success and what that's being measured on?
Yeah, it's a couple things. Gen Z, it's really interesting. We found that Gen Z is more innovative and financially savvy than most people might expect. This group is changing jobs at unprecedented rates, primarily to increase their salary. This group's also, they're masters of the side hustle, Brad, earning more by starting new businesses and following their passions, and they're investing in really cool and interesting ways.
And so with that in mind, for those of us who are, aspirational energy, Gen Z, if you will, how can we ensure that we are also deploying our time correctly to, be more ingenuitous about where we are kind of creating some of these side hustle opportunities and making sure that it's accelerating some of our retirement goals as well?
Well, I think there are a couple things to keep in mind as people tap into just more side hustles and things of that nature. Just keep in mind, a lot of these things have impacts to your taxes. So that's the number one thing. Just keep that in mind. They're both benefits and they're consequences. So I think the most obvious impact is as you take on more side hustles, it has the opportunity to increase your tax rate if your job change pushes you into a higher tax bracket. I think there are a lot of other tax benefits that may be less obvious, including potential job search and moving expenses and whatnot. What I will say, Brad, is H&R Block, we recommend checking your W-4 as you do pick up more side hustles and begin potentially new jobs. We provide an easy tool to enable consumers to see how these W-4 changes can impact their taxes.
Even as you think out to the future, a lot of Americans are trying to understand what type of policy changes may come in 2025. I wonder what you're advising clients right now who are trying to get ahead of their own tax planning and best configure their own both income, their payments that they're making, and any type of financial considerations going into some of those changes.
I think about a couple of things. Oftentimes people think that taxes are a retrospective view. I would encourage people to think about taxes proactively. There are many things that we can do as consumers to get prepared for taxes. You mentioned one in an earlier session. Thinking about charitable contributions, right? Those can absolutely help so many people tax-wise, and they can help society as well. Thinking about contributing maybe a little bit more to your 401k could also be a thing that impacts you, not just in the near term from a tax perspective, but long term when you consider your retirement.
Curtis Campbell, H&R Block, President of Global Consumer Tax. Curtis, thanks so much for taking the time here with us today. I appreciate it.
Thank you, Brad.
Certainly. Coming up, everyone, we've got the third installment of Yahoo Finance's Fearless. In the latest episode, we take a closer look at the highs and the unexpected lows of trying to grow a small business in America amid a rising cost of goods. But first, we've got your Yahoo Finance market update with our very own Rochelle Akufo. She'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day, and it's time for Yahoo Finance's market update. Post-election momentum slipping this Friday morning, with the major indices on track to end the week in the red. So here are 3 trending headlines that you need to know this hour. First, Bill Ackman, the billionaire hedge fund manager, activist investor, and founder of Perishing Square Capital Management, more than quintupled his position in Nike and alternative asset manager Brookfield. Investors watch Ackman as he's known for his concentrated portfolio of less than 10 holdings and for taking large positions in companies to push for change and unlock value for shareholders. Plus, looking at Amazon's One Medical service announcing low upfront pricing starting at $10 for a range of health and lifestyle services for Prime customers. That includes hair loss, eyelash growth, anti-aging, erectile dysfunction, and motion sickness. Telehealth companies that compete in those areas, including Hims and Hers, taking a hit on their share price today. And finally, FuelCell Energy announced a global restructuring plan. The company is looking to reduce total operating costs by about 15% in 2025. Plans include a 17% reduction in FuelCell Energy's workforce and reduced spending on product development. For a profit boost, the company is betting on the AI-fueled growth in data center energy demand. And that's your Yahoo Finance market update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. More wealth when we return.
Nearly 80% of small businesses say rising costs of goods, services, and wages have created a financial burden, according to the Federal Reserve. This can become a challenge at any stage of business, including the growth stage. Japanese and French-inspired premium chocolate brand Ducranes is one of millions of small businesses in that growth stage, yet dealing with a huge increase in its number one ingredient, cocoa. In the latest episode of Yahoo Finance's Fearless, we take a closer look at the highs and unexpected lows of succeeding as a small business in America. Take a look.
Right now, as a chocolate shop, the biggest challenge is the price of cocoa. The price went up 35 to 45% on an ingredient that we use in like 99% of our product line.
There are numerous stages a small business experiences before it becomes successful and profitable. There are the concept and the startup stages. Then there's the growth stage, the phase when a business has steady profits, loyal customers, and a well-established operation. But what happens when unforeseen challenges arise? Here's how one premium chocolate company is looking to grow its business while juggling a spike in cocoa prices.
Ducrane's is a Japanese and French-inspired premium chocolate brand. We specialize in making chocolate bars and bonbons and other confections that are rooted in the tradition of French chocolate making and inspired by the flavors of Japan. I moved to Japan when I was 5. I'm half Japanese, and my mom is Japanese American. Ducrane's is really also kind of like a love letter to Japan. Cranes are very famous in Japan for being symbols of longevity and prosperity, and the two cranes are kind of the French traditions with Japanese traditions and mixing them to create something new.
What she's talking about is really the hottest trend in chocolate. It's taking ethnic flavors, taking unique styles, and combining them into something that everyone knows about, which is chocolate, and turning it into a really special experience.
I think what brings people in is our packaging. It's super simple, very elevated, very premium. Our molds are very inspired by Japanese motifs. I think on the shelf, they're beautiful, and then people eat them, and then they want to have them again.
Really important. Psychologists say that you eat the package. There's so much competition, and there's so much quote-unquote noise on the shelf. Having great packaging, having interesting flavors, having a bit of novelty that's combined with familiarity, those are the elements that create loyalty.
I started the business in September of 2018. We first started operating in farmers markets and then eventually purely wholesale. And then we added on e-commerce and finally a retail physical location in Northern California.
Usually a product begins to expand when they start to feel the customer asking for it. In retailing, there's something called a push and pull. You would love to have your product be pulled, which means that there's a lot of noise on the internet, that people are talking about your product. So you'd like to have that demand already out there and people say, where can I find it?
What I've learned in the 6 years that I've been in business is that nothing is for certain and nothing is in your control either. So you have to kind of figure out ways that you can diversify enough without watering down the brand. We make about 50,000 chocolate bars a year. Last year, we made right around $800,000. This year, I'd love to be able to get past the $1 million mark. Due to climate change and a lot of different factors, we're seeing an increase in the cost of chocolate up to about 45%. So the question is, how can we adjust our strategy to be able to weather this storm? Last year, before the chocolate crisis, we were looking at closer to like 99% of our product offerings being chocolate-based. Now we're probably at 3 to 4% being non-chocolate items or less chocolate items, and then looking to grow that closer to 10%.
The only thing you can expect is the unexpected. Contingency is the name of the game. Build in a contingency, 10, 15, 20% of the capital you think you need. You have to have a plan B to say, if this happens, where can I get that money?
We looked at adding more fruit jellies more regularly. Same thing with caramels. With cookies, we're launching more cookies.
Anytime a company can diversify, it's an opportunity to increase sales. The challenge comes when you diversify, you have to manage all of the products and make sure that the products that you diversify, A, don't take away from your main product, B, that are equally as good, if not better, than the current product, and C, make sure that the market that you're going after is the market that you're hoping to get, because you don't want to broaden your appeal so that you've lost your focus.
We are currently expanding our footprint, our physical footprint, to be able to make more product. So the idea is that we would get some amount of, scale efficiencies, but then also the thing after ingredients that's most expensive is our labor costs. The plan is to bring in new machinery to be able to take away a significant part of the raw labor. So the machines help with the tempering, they help with the pouring. Our staff are on hand to do the quality checking and everything in the packaging.
This is really critical. In order to maximize profitability on a manufacturing business, you have to have systematization. If she can minimize labor, which is going to be one of her most lingering and most challenging costs, by using some type of automation and without minimizing or sacrificing quality, she's doing what a really experienced and skilled manufacturing person should be doing.
Right now, we're able to make about 300 bars per day, including packaging. And with the mechanization, we'll be able to go up to about 500 bars an hour. Perfect, so 59 is your total whenever you're ready. For our chocolate bars, we raised everything $1, which is like 7 to 8%, depending on the bar. Our permanent collection went from 13 to 14, and then our bonbon also went up about 7 to 8%.
Pricing is both science and art. The science of pricing is you certainly understand the cost of your ingredients, the cost of all of the labor, the cost of packaging, but there's the art of pricing. Where does your product fit into the marketplace? Where does your product fit in with comparable products that are artisanal chocolate, that have the beauty and the specifications that yours have? You raise prices carefully, understanding what the competition is doing and understanding the circumstances.
When I go visit stockists, I check out the prices and I see how much elasticity our product pricing has. I didn't want people to feel like I was price gouging them. There's a lot of competition in the marketplace. I wanted to be sensitive for the future of the company, that we're not tying all price increases to specific events. I think it's really about the quality of the product, and telling that story I think is also really important. Talking about where we're sourcing our ingredients from. Our cherry blossom bar, we source the ingredients from Japan. We pay duty to import stuff here. Our boxes are made with the highest quality paper available on the market. And I think when people know the story and they know how much love and care goes into the product, that's what they're buying. They're buying the chocolate because it's delicious, but they're buying the brand.
Customer value perception is incredibly important. The challenge is we all have different value perceptions. If you have a product that is really unique and offers something that nobody else does, you can do what's called value price, where you can take the selling price of that and increase it because the perception of value will be strong for that customer. In order for you to do more and more premium prices, you need to have a good story. And the story needs to be something that resonates with your customers so that they understand it.
I handwrite each note to each customer. It became such a big part of our business, and it's really, I think, shaped kind of the ethos of why we operate at such a high level. It's been really incredible to see how people choose us to be able to say, I love you, or I'm sorry, or, condolences, or whatever it is, congratulations. It's been really special. In the future, we'd love to be able to have more retail spaces. And the ultimate goal is being able to have a storefront or some presence in Japan. One day, I'd love to be able to take the brand back there and be able to show everybody what I did.
Yahoo Finance has teamed up with former Congressman Patrick Murphy and technology executive Dan Koons for Warrior Money, a new show dedicated to uplifting the financial well-being of military veterans transitioning to civilian life. On the debut episode, Admiral Bill McRaven talks about the importance of finding purpose in a new career path. Take a listen.
When I look at the financial world, so much of this is about my 401k, or my investments, and how are those going to be a benefit to my family and to, oh, by the way, not just my family. So if you work for Lazard or you work for any of the big banks and you're making money for your clients, what you're doing is you're setting their family up for success for the long run. So don't forget, it's not just about making money. It's about making money that, in the long run is going to help families grow and be more prosperous. But if all you think you're doing is making money so that the fat cats can get fatter, well, then you're not going to be inspired. You've got to make that connection between those causes that are good and noble and honorable.
Yep. That why they do it.
Joining me now is Patrick Murphy. He is a former U.S. Congressman and the 32nd Army Undersecretary. And we've got Dan Koons, who is the Vice President of the Task Force Movement. Guys, great to have you here on the program, and congrats on the new podcast launch here and the partnership with Yahoo Finance. What did you guys think about Bill's advice?
It was spot on. And listen, Dan and I are both Army veterans, former Army officers, and we're trying to help our brothers and sister veterans. And so to have someone of the caliber like Admiral Bill McRaven, who's wrote that New York Times bestselling book, Make Your Bed, who is just a international leader and someone that everyone that wore the cloth of our country respects, to give that advice about knowing your why and knowing that you're still going to live a purpose-driven life even after you leave military service is incredibly important. And that's why Dan and I are just so happy to be part of the Yahoo Finance family.
Yeah, Dan, want to bring you into this as well here. I mean, what can our viewers really expect to hear? More profiles, especially as we are looking to kind of make sure that veterans have resources like the discussions that you're bringing to the table here in order to get jobs, be able to grow out their own wealth as well over time.
Yeah, it's really important for us to bring a diverse cross section of folks across the veteran community, also the veteran entrepreneurship community, the veteran finance communities, bring everybody together to discuss like what matters and how do we transition? What does it mean to be financially free, independent? How do we work towards those goals? And I think Yahoo Finance is just a great platform to have those conversations. We can talk everything about personal finance up through what do you do as an entrepreneur? How do you build businesses? What does it look like to get into Series A, B, C funding? What does it look like to go to IPO? We can have a range of conversations because the veteran community houses all those sorts of folks.
Patrick, what are companies doing? How are they working to help veterans find the right job?
Doing a ton of stuff. As you know, there's about 200,000 veterans that or active troops that leave and become veterans every single year. So there's great organizations like the Hiring Heroes Foundation, and you have other companies like JP Morgan Chase, like Comcast, like Johnson Johnson, that are really trying to make sure that when you leave, your military career, you go up and you can join a formation, you can join a company that's going to value what you bring to the table, that is going to value you and let you live a purpose-driven life, to continue to give back, to the community, to your family, and do what's necessary to be a team player and help them grow and succeed.
Dan, as you think about the industries and careers that you're hearing veterans sound most excited about, where are you seeing those opportunities?
Yeah, it runs the whole gamut. The beautiful thing about our United States Department of Defense, and those who have served in it, we touch pretty much every cross-section of industry in our service. So banking and financial services, technology products, and logistics and operations. The Department of Defense is a logistics and operations business at the core of what we try to do. Get people and things from places, protect and transport, and make sure the supply chain is functioning the way that we need it to. You also have a strong presence within the cybersecurity community. So technology, finance, logistics operations, and cybersecurity are areas that we're really used to supporting.
Patrick, as you think about your own history as a congressman and now as we're kind of looking out to 2025, the makeup of DC going to be changing, how would you like to see veterans prioritized in those conversations?
Well, I want to make sure that our elected leaders in Washington, I used to be one of them before I went to the Pentagon. I don't want them to give lip service. I want them to see our veterans as civic assets. And that's why Dan and I are so excited about Warrior Money, on Yahoo Finance. To let our brother and sister veterans know and active troops know that there is a way forward, that what they need to do to be fiscally responsible about balancing budgets, where they should invest their money, what they shouldn't do, and how hard, frankly, entrepreneurship is. I mean, we're both entrepreneurs, or what we like to say, veteranpreneurs. But, some of the most iconic global brands were started by veterans like Walmart and Comcast. So, but whether they want to go be an entrepreneur, whether they just want to make sure they're doing right by the money they are bringing in, that's what Dan and I are there for.
Patrick Murphy, former U.S. Congressman, and Dan Coons, who is the Task Force Movement Vice Chairman. Great to have both of you here with us. Warrior Money premieres today, 12:30 p.m. Eastern Time. You can watch every Friday on Yahoo Finance or wherever you get your podcasts. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned. Market Domination with Julie Hyman and Josh Lipton comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.